Okay. Hello, everyone. Thank you today for joining us for our Croatan conversation on 10 years of total portfolio activation, a conversation on amplifying impact across investment asset classes. This is part of a larger series that brings together leaders working on the front lines of finance, social change, and ecological resilience into deep dialogue about collaborative opportunities to invest in solutions to some of the world's toughest social and environmental challenges. This is a project at Croatan Institute, an independent nonprofit research and action institute. Our mission is to build social equity and ecological resilience by leveraging finance to create pathways to a just economy. To start with, as people are logging on, I want to do some housekeeping notes. This conversation is being recorded and it'll become available on our website and YouTube page. If you're on Zoom, you can ask your questions using the Q&A box at any time. Feel free to add it in, and we'll do our best to answer those at the end of the presentation. If you're watching on our LinkedIn streaming, you can try to post your questions in the comment box, and we will do our best to answer as many as we can at the end. Just a quick note that we may be talking about investments, and because it's a regulated industry, we want to make sure you know we're here to educate and not solicit. If you hear about a product, please do your own due diligence. This is not considered investment advice. If you enjoyed this conversation or other Croatan conversations, there's many ways to support them going forward. You can make a donation today at our website, or when you're registering for conversations, there's always an opportunity to add a donation as well. But consider asking your firm to sponsor a future conversation. And if you have a moment at the end, please fill out our survey form that pops up at the end of the conversation and let us know how we're doing and what you'd like to hear us talk about. Finally, you can find us on all the social media channels, so keep the conversation going there as well. So I'm Christi Electris. I'm a fellow and co-founder of Croatan Institute, and I'm excited today to be moderating a conversation marking the 10-year anniversary of a critical report and framework that's influenced so much of our organization's work. Our total portfolio activation paper was commissioned in 2012 by Trillium Asset Management and Tides Foundation, and the report was prepared by Josh Humphreys, Ann Solomon, and myself while we were at the Trillium Institute, with research assistance from my colleague Jamie Silverstein as well, and with the guidance and close collaboration of both Trillium and Tides and the remaining speakers on this call today. So I'm joined by the co-authors, Josh, who is my co-founder at Croatan Institute, and Ann Solomon, who is now at Inclusiv. And representing the co-sponsors at the time, Matt Patsky from Trillium Asset Management, Nancy Rosenzweig, now of Values Aligned Capital, and Melissa Bradley, who is at 1863 Ventures. I'm going to have them all introduce themselves shortly, but first I want to take a few minutes to introduce the Total Portfolio Activation Framework for our audience before we dive into some questions about what this report meant at the time, how the framework has shaped each one of our panelists' work to date, and where the field of impact investing may be going from here. The framework of total portfolio activation, or TPA, has become a go-to resource for investors seeking to understand investment opportunities for creating social and environmental impact across asset classes. As a framework, it provides a set of analytical tools to help mission-driven investors understand their specific impact opportunity set that can be pursued across every asset class in their portfolios. TPA starts from the understanding that every investment across every asset class has social and environmental impacts, both positive and negative. The framework is applicable to any investor seeking to generate greater environmental or social value, and its underlying tools can be tailored to very specific issue areas of concern. The tools are especially helpful for institutional investors like foundations, endowments, faith-based investors, nonprofits, and other mission-driven investors looking to align their investments with their programmatic goals and values. Using this approach, investors can work toward a fuller activation of their portfolio in support of their mission. We identified in our original report 4 related areas of activity where opportunities for impact can be readily seized within each asset class. Investment selection that incorporates environmental, social, or governance issues and impact into investment review, decision-making, and performance analysis. Engagement, or exercising the stewardship rights and responsibilities, the voice and votes that often accompany owning an asset. Networks, joining wider groups and coalitions of stakeholders around common environmental and social issues of concern in order to leverage collective power and generate greater impact than any single investor could on its own. And policy, engaging in public policy activities as an investor in order to tap government resources and incentives, or to encourage regulatory oversight and intervention in support of impact objectives. Since launching the framework in 2012, we've repeatedly applied this framework to expand the fields of impact investing. And we've done so in 3 broad thematic areas at Croatan Institute: diversity, equity, and inclusion, climate, and food and agriculture. You can find all of these reports and more on our website, croataninstitute.org/TPA, and it'll take you straight to that section. So I'm going to when we're working on these deep dives into impact investing themes, we've collaborated with dozens of partners and sponsors, and we talked to many more leaders in the space while we're conducting our landscape research into each impact theme. There's dozens more, but these are the ones that are partners on some of our reports. I would want to walk you through some of the analytical tools that we're talking about just quickly, so you can dig in deeper in the reports themselves. In our TPA Venn tool, we start by mapping the overlapping ESG themes that we uncover in our landscape analysis of a specific theme that we're focusing on. And we identify how investors are able to create positive impact in that environmental or social issue that we're focused on. So most recently, this is pulled from our report Capital at the Crossroads, Accelerating Racial Equity Investment Across Asset Classes. And this was just published in October 2021, last fall. Our TPA matrix tool identifies the impact opportunity set, which essentially communicates how much potential impact can be had in a particular asset class for each theme. This is coming from our 2017 report on impact investing in sustainable food and agriculture across asset classes. At the time, it was listed as it was lauded as the most comprehensive report on the sector to date. And currently, since then we've done a report called Soil Wealth that was published in 2019 that goes into even further depth and focuses really on regenerative agriculture, kind of pulling that theme and breaking that into sub-themes as well. But here you get a sense of which asset classes are most powerful for creating impact for specific sub-themes. A key part of the TPA process that was originally designed was to analyze the impact of what's in your portfolio right now before taking on activation for your chosen social and environmental themes, and then reevaluating after you've gone through the process, and then continuing to do so on a regular basis. Here you see a before and after TPA scatter taken from a hypothetical portfolio of an investor looking to integrate gender into their portfolio. This is coming from our 2015 paper on investing for a positive impact on women. It shows different vehicles and asset classes that are represented in each bubble, and the size is conveying the amount of assets invested. And you can see positive and negative social and environmental impact from the placement of the bubble on the X and Y axes. In this case, the color represents how many gender lenses or sub-themes were applied in the specific investments chosen. As the portfolio is activated more fully, the investments move up to the right and become deeper shades of yellow. And we continue to make more tools. Our most recent TPA tool has just become public with our recent launch of a beta version of Razor, our research analytics and insights for social and environmental returns. It's our TPA toolkit, an online research platform that provides investors with a set of analytical tools to identify and ultimately activate more of their portfolio for social and environmental benefit across asset classes. I encourage you to check it out after the conversation. There's both a free and paid version, and you can also get a free one-day trial or reach out to us for a demo at any time. So with that, I'm now very excited to turn it back over to our speakers to begin the conversation. Of course, it was a very different world 10 years ago in the impact investment space, and I'm going to ask each of you to please give us a brief introduction, including where you are now, your place in firm, and what was your role 10 years ago when we released the TPA framework. How did you at the time, or how do you view it now, this framework? And I will start. I'll just outline, and maybe you can pass it along. I'll ask my co-authors, Josh and then Anne, to start, followed by the co-sponsors and collaborators, Matt, Nancy, and then Melissa. And with that, I'll stop my sharing as well. Thank you.
Thanks, Christi, and thanks everybody for being here today. I'm Josh Humphreys, president and co-founder of Croatan Institute. I'm also a senior fellow here. And 10 years ago, going back to 2012, I was in Boston. Now I'm in North Carolina, where the Institute is headquartered, but our team is scattered about all across the country, and we have a presence in Europe as well. So that's a big change for me personally. As Christi mentioned, Anne, Christi, Jamie, and I were all affiliated with Tellus Institute, the sustainability think tank in Boston, where we all met. And out of which the Institute was launched in 2013. So that's a huge change in terms of our own kind of professional positioning. Has been excited to launch a new entity that really provides a platform and a place where we can continue to deepen the application of total portfolio activation thematically, as well as to get, I think, much more deeply enmeshed in certain asset classes. I think back in 2012, I was excited by the prospect of working with Nancy and Matt and Melissa on this. And, we should give real acknowledgement to Nancy for being the instigator of this. And, I'm sure Matt will have more to say about it, but at the time, impact investing, the language for which had only emerged in around 2007, 5 years before. It was a term of art that aspired, I think, in some of the initial conceptualization to address a multiplicity of asset classes. But in terms of the framing and practice of impact investing, it was often understood that if you don't invest in private markets and you can't touch and see your investment, you really can't have impact. And I think that was the real fallacy that many of us were concerned about, because that meant leaving a lot of assets on the table. Some investors in our world were willing to leave Wall Street completely and to go purely private. But the fact of the matter is, in the public markets, there's still a lot of activity, and we really needed to think holistically about it. So on one hand, it was an effort to, I think, for many of the practitioners to really enlarge our scope for doing impact investing across every asset class. But for me personally, I came out of academia teaching at Harvard during the financial crisis, and I shifted my attention away from philanthropic mission-related investing to endowments. And this was a really serious concern for me, because endowments, particularly blue chip endowments, provided a real model for institutional investment across asset classes. And the endowment model of investing was, in many ways, my chief concern. And total portfolio activation provides a radical alternative to modern portfolio theory. And hopefully we can get into that in the discussion, because I don't want to say much more about that. But back then, I was excited by opportunities in certain asset classes I think endowments had gotten into very early, like real assets, particularly farmland, timberland, but had done it in a really challenging way. Indeed, in a rapacious way. And I think Anne and I worked on some projects around land grabs as well when we were at Tellus together, and Christi was involved with some of that on the community side. And so I'm extremely excited 10 years on to be working really substantively with place-based partners, helping them do conservation acquisitions, help them change the way that land is used, and to really show that there are huge opportunities to do really interesting, what at the time I called in a paper, post-carbon portfolio management, really across asset classes. So with that, I'll turn it over to Anne. Thank you so much.
Thanks, Josh. Yeah, it's been fun to look back a bit and think about where I was 10 years ago. I had just finished my master's in urban planning. And so my focus was always on the kind of community investment, community development side of things, and had begun, working with Josh and Christi and Jamie at TELUS on, the CDFI investing side of things in this broader total portfolio activation. But I think for me personally, I think the Great Recession plays a large role in. It was an inspiration both for me in my individual investing, but also in my career of how can we really look at ways that impact investing is viewed not as something niche or something to the aside and apart from traditional investing. It's not a side project or a fun thing to do on the side like a hobby, but it really is about bringing in a holistic and intentional view of your impact across all the types of investing that you're doing. So for me, that was a great, I was really grateful to be involved with it. And it was exposure, I think, more to the other aspects of the other asset classes and other types of investing coming from kind of the CDFI world, at that time coming more from the housing world. And today I am Senior Vice President at Inclusiv. So I work with our network of over 400 community development credit unions on advancing impact in low-income communities, and particularly in communities of color. And so kind of went 10 years ago from being the research side of things and reaching out to folks to get information about what was happening in community investing, and today being on the other side of it and helping grow that community investing. So I think with that, I'm handing it back to you, Christi.
Yeah, and we'll turn over to Matt next.
Great, thank you. Thank you, Christi. And just in terms of where I was 10 years ago and where I am now, I moved around the corner, but I was 10 years ago the CEO of Trillium Asset Management and still have that role. And 1982 was the founding of Trillium, just sort of give you some background. And I would just say, Joan Bavaria founded the firm with the objective of providing for the financial needs of our clients while leveraging their capital for positive social and environmental impact. That is in the opening documents in 1982. The concept of investing for positive impact is not new. It was not invented by Joan Bavaria. It was not invented by the gin. It was literally probably as old as money. And there are references in scripture dating back over 1,000 years to talking about the positive impact you can have around with the community, with the way in which you invest money. So just sort of get that out there, that we were fascinated by all of the developments we were seeing around us in the time frame of 2010 to 2011, with there being a declaration that impact investing was private and only private, that it was also a new asset class. That was an interesting one. And Nancy got most of this in the terms of hearing my frustration and some unpleasantries of what I considered it, about what incredible BS that all was. And Nancy said, we need to come up with a white paper to explain that all investment has impact, and that people, should understand whether it's positive or negative, and people should know that they can move their portfolios to having positive impact across the board. What we were also seeing was, and this was a great frustration, right? We were seeing people package product together and call it your impact portfolio, coming out of firms we all know and hold dear now, that were putting 95% of your assets in ETF and index product that was broad market, and saying, but you'll own a little root capital promissory note here, and a CDFI over here, and we'll put some of your cash in a nice community bank. And this is your impact portfolio. And so we were trying to call attention to the fact that we can't ignore the impacts of 95% of our portfolio and then dress it up with 5%. That we have to step back and look at the broad impacts we're having. And so that was the sort of call to action that we were seeing. And I think we certainly pulled together the right group of people to make it happen, because the charge we gave the team at TELUS at the time was, we want to create a white paper that's compelling enough that we see it used by the industry broadly, and that we get to hear stories about our competitors going into pitches using this white paper. And that has been happening for almost a decade. So it was, it was the need for us to really say, look, impact investing, as we said, is not an asset class. It's a way of investing, right? That requires being conscious of the social and environmental impacts of your investments. And what impact investing is calling people to move towards thinking about how every investment is having an impact, and trying to move toward making sure that those impacts are positive and are aligned with your values. So, and I'm amazed that this is a 10-year anniversary, but to answer, there's a comment in chat that I'll just say, no, you cannot have positive impact on the world if you invest your money to maximize your income to then donate to try to solve the problems you've created. And that is a fundamentally flawed thought process that we've got to break all of the endowments and foundations from. Not a good idea to ignore the impacts of your corpus of your endowment because you're, quote, doing good work with 5% of it annually. But anyway, with that, I'm going to turn it over to Nancy, who really led the beginning of sort of thinking about how this all needed to come together. So thank you, Nancy.
Okay, so Matt, you guys have covered a lot of it. I would just say, 10 years ago, I was doing this in some, different iterations of the same thing. My passion has always been, how do you help enterprises that have positive social environmental missions scale? How do you help them grow? And, at Trillium, I was on the board, and then, helping to consult with Trillium. I was helping to get other social environmentally responsible businesses off the ground as an operator and as a consultant. And, in my partnership with Matt and to help assist Trillium, I would say, I'd like to say, put in a word for enlightened self-interest here. Part of what makes Trillium more successful is to have more assets under management. And, when people are only giving you 5% of their assets, it doesn't really grow when you can't make as much of an impact. But I think, as Matt has said, there's just a general frustration with having impact investment being seen as its own asset class, and at that, a concessionary asset class, when we knew that there was so much opportunity for people to make ultimately better than market returns across all of their asset classes while trying to do good at the same time. And it was kind of, thinking about that exercise now, we're trying to come up with case studies to show people what a model portfolio could look like. And the choices were out there across every asset class, but, we'll get to talking about how that's really mushroomed over time. And there's so many more. So we were really, using the bare bones to demonstrate this as a concept. Now it's really out there. There's really lots of opportunities to make market rate and better than market rate returns across all asset classes. So I'm excited to get into talking about that. I've morphed the way that I have worked with companies as a financial consultant and intermediary, and I'm helping with values aligned capital to connect companies with who again have the positive and environmental and social missions with the right kind of capital so that they don't lose their missions when they grow. As an operator, that was, one of the stumbling blocks I found when I took money from the wrong parties, that it was hard just to have that tailwind at your back to grow your organization, and that it'd be easy to get misaligned with your mission. So that's the way I'm working on it now, and I'm looking forward to discussing the next stages of this conversation. So, and I want to say, when I was thinking, okay, who can help out with this project? We needed it funded, and we needed some good minds on this. And we found Telus at the time, and we're more than happy with the way that they were working on this. But Melissa Bradley at the time, who I'd known for many years, who was super smart, really passionate about these issues, and had a great platform at the time with Tides. And I called her, and I didn't have to ask twice. She saw it immediately what the potential was. It was terrific to pull this team together and to be together with you all again now. So I'll let Melissa tell her story.
Sure, I'll keep it brief. When Nancy calls, I show up. I may be late sometimes, but I still show up. I think there were two reasons why. I mean, back then I had the privilege to be CEO of Tides, and it was the first CEO post the founder, and there were tremendous opportunities for us to really reimagine what the future of Tides was going to look like. It was an opportunity to go back to many of our customers who at the time were majority individual donors, and really understand what their investment theses were and what they really expected of Tides. And this was a perfect time because people were using terms, but not always impact investing. And so it was an amazing opportunity for us as an organization to be associated with such an amazing team, to provide almost a roadmap for our donors that hopefully would manifest into obviously more assets under management, and more directional and focused opportunities to really amplify impact investing. And for us, that was important both on the individual donor side, but also because of the institutional funding collaboratives. It was a great tool to be able to give to all of our philanthropic partners, say, hey, are you familiar with this? As you come to set up yet another donor advised fund collective, let's start thinking of other ways. And I would say, moving 10 years forward, it's a cornerstone in a class that I teach at Georgetown, where I'm a professor. I teach impact investing to MBA students. I'm also a fund manager, so I'm a GP at 1863 Ventures and a venture partner a couple other places, and on the board of a few other venture funds, both local and nationally. And all of those funds actually look at women and or entrepreneurs of color. And so for me, when I look back 10 years, how we were just beginning, and I think coming forward 10 years, we've made progress in some areas and not others. I think we are doing very well when you start talking about sustainable investing environment, and part of that is because it's quite quantifiable. But where my passion lies with helping new majority entrepreneurs and trying to bridge the racial wealth gap, we don't have as great indicators. And so from an ESG perspective, when I teach my class, I'm like, we are killing it on E. We have some good frameworks for G. We suck on the S. And so my hope is that it's a tool I still use, and I challenge my students to think forward. And my hope is that this 10-year anniversary will help people to go back, use it as a minimum baseline of what they're doing now, and then hopefully this conversation and many others can help advance them. So I appreciate the opportunity to be here.
Great, thank you so much. I'm glad to have all of you here as well. So obviously things are very different right now. There are so many more opportunities, and people are talking about impact investing across asset classes, much more so. And we're lucky that, amongst all of these speakers here today, we're representing a lot of different perspectives of the impact world. So I wanted to come back and see if you could tell us a little bit more about the deeper expertise you bring from a particular perspective, and specifically your asset classes. So I think, Matt, we'll start with you. As a CEO of a sustainable investment manager, particularly, you have the public equities perspective, but you also touch across asset classes. So if you can elaborate on your, yeah.
Thank you. Yeah, so what's been interesting is what I think really TPA really set the stage for was an acknowledgement and recognition that what is really needs to be different about how you have impact in the public markets than perhaps other asset classes is that you had to be an active owner engaged with pressing company on changes in behavior. And of course, yes, that was one of Trillium's core strengths that they had been doing since founding, which is one of the reasons we kept saying, yes, you can have positive impact in the public markets. And yes, I do know you're exchanging secondary shares when you buy stock in the market. So I get that one as a retort from people who say, no, you can't. You just simply bought shares from someone else. And I'm like, yes, but there are other impacts that you can have as an owner. The reality is the reason why most asset flows over the last 40 years had moved toward indexing and toward passive ownership, in which people were disregarding the responsibility, quite frankly, of ownership. And that included the major asset managers, right? Who had developed literally the standard proxy voting policy, no matter what they told you it was I vote with management. I don't want to piss them off. I don't want to lose the 401k business. I don't want to lose the banking business. I don't want to lose whatever other tentacles their businesses had. They didn't want to disrupt any of their other businesses. And the path of least resistance, particularly when the investors who are coming into the pooled vehicles aren't asking me to do anything, is to vote with management. We're now seeing we're now holding their feet to the fire, right? We're now demanding that they be thinking about what's in the long-term best interest of the company and the shareholder and society. And you're seeing changes that are occurring on a very big level with players like BlackRock. And that all came out of a lot of what we started talking about, which is the impacts you're having in public equity come from acting as an owner. And in order that, once you act as an owner and you behave in the best interest of the long term of that owner, you are thinking about environmental social impact, and you are addressing that in the conversations you're having with management. So I think the last 10 years have seen an amazing shift of, I think, a recognition. Yes, my investments in public equity have impact. And yes, I as an owner should care about them. We still need people to step back and really think about what they own. I am amazed at how many of us in this industry work for firms where we're sitting in target date funds that are simply broad-based ETF, broad market indexes, and broad market index funds on the fixed income side that are being adjusted over time in terms of allocation, paying large fees, investing in everything, and having no idea what they're invested in, right? How many times I've stood before a group and said, where is your money invested? And they're looking at you and they're like, I don't know. But you should know where your money is invested, because whether you have $10,000 or $10 million, the money has impact. And the asking of the question of how is it invested, it can start to move money. And so for those who are not aware, the largest pension plan in the United States is the federal pension plan, the Thrift Savings Plan. They have announced they're going to open their architecture beginning this summer to allow people to invest beyond broad market index product. They'll finally be able to pick something. They can go ahead and choose a fund that actually considers environmental and social. And that's, that's incredible movement of capital, and we needed to trigger that. And I think all of the work that was done helped to lead to this, to where we are today. Still a lot of work to do. And Melissa's right. We got to work much more on social and measuring and standardizing how we're requiring reporting on social issues. But we've made a lot of progress, and what we need to see is movement into trillions in order to really alter the outcomes, right, that we're facing. So I think Nancy is next. So I don't know.
That's great. Actually, I was going to turn it to Melissa.
Okay.
if you wanted to comment a little on your perspective, you were running Tides, as you mentioned, with this total portfolio approach, but now you're also have asset class specific perspective around private debt, venture capital. How do you see this, the evolution of this framework?
Yeah, I would say that by the time I left Tides, we had dramatically increased, I would say, both the education and what we were anecdotally told, the allocation of dollars to impact investing, because obviously we had a desire to get more grant dollars under management, but we also did a lot of referrals to other funds. And so anecdotally, we saw an increase in a desire for our folks to really balance out their values across all of their asset classes and across all of their kind of financial managers, which I think has been a huge friction point in terms of the lack of knowledge. We found significant gaps in intermediaries such as lawyers and accountants and financial managers. And I would say that 10 years later, again, anecdotally, I know there have been many firms that have come online to be able to provide that education and support. And so I see it's moving. I use that anecdotally because I don't have the numbers, but I would say we at 1863 Ventures and many of the other funds that I'm a part of, we are usually specifically focused on impact with the initial lens of being gender or race ethnicity. And then we do indeed bake in kind of long-term impact covenants. We say for us at 1863, we really focus on job creation. We recognize that the racial wealth gap can be somewhat stemmed if people have access to full-time employment. And we also know that the lack of investment, particularly in Black businesses, has actually caused over 1 million plus jobs not being created. So I want to preface by saying we are focused on this because we see the economic opportunity and imperative. When Citi produces a report that's like $16 trillion has been the cost of racism, I don't believe the country can continue that anymore. And when you look at the world of entrepreneurship, with over 4 million new businesses started since COVID, and a majority of those coming from Black women, I really want to preface, I don't do this because I am the target population, of which I think is a good thing, but I do it because the numbers are leading me there. And so I preface with that because I think it has been very disappointing that the impact community has not really thought about how do you look at gender and race ethnicity issues, particularly when the data demonstrates that there are tremendous opportunities. In last year alone, $300 billion went into new venture capital funds that were run by Black GPs. And so because of a variety of groups that I'm associated with, I would say that I'm optimistic on what that's going to look like over the next 10 years. Many of the new GPs are very much focused on women and or entrepreneurs of color, are very much focused on job creation. And I would say we have seen, again, anecdotally, a dramatic increase between the 6 funds that I'm associated with, including one where I'm GP, a dramatic increase in environmental focus amongst entrepreneurs of color. I think we have to be mindful that some of these larger aspirational, and I use that intentionally, kind of ESG goals are hard when it costs a Black entrepreneur $250,000 more to start the same exact business as their white peer. And so we do have to be mindful that there is an intentionality and interest amongst women and entrepreneurs of color to be much more impactful, however you define that. But we have to recognize that in many cases there are incremental costs in doing so. I'll say one last example. I have the privilege to be a co-founder of a company called Eureka, which is a venture-backed company. And it took us a long time to find investors who were going to support our impact. We've raised over $13 million, but it is a small business platform solely focused on women and entrepreneurs of color. Anyone is open, but over 85% of our members are that. And that was a hard sell. We spent a significant time in Silicon Valley, and people were like, well, you could be right, but we're not really sure. And I will say that the piece there, of the takeaway that I would give is that part of that narrative of uncertainty, particularly with women and people of color, is because of lack of data. Which is why I'm thrilled to still be at Georgetown, because I think if it's hard, right, to say, oh, there's a racial wealth gap, but they have all this purchasing power. It's really hard for people to reconcile. It's hard to say women are powerful, but in their own world, in their own sphere. And so I would say that what TPA did then, that I hope many more reports will do, is provide a baseline set of data to people make more informed decisions, which did not exist before.
That's great. I'm going to turn it quickly to Anne, and then we'll go to Nancy and Josh. And I know what we want to talk about. And you're working with the community development credit unions, and so it's natural to ask about cash from your perspective. But also, Inclusiv is a private CDFI debt investor in community development credit unions. So, just how does it? What's your reflection on the evolution of this?
Sure. I think that cash and the CDFI credit unions and banks, I think in many ways we can often be, or impact deposits can often be kind of the gateway drug of impact investing. They're federally insured. There are a lot of ways that investors come to us, and that impact deposit is their first step in this direction. And so I think it's the field has grown, and the types of investors coming to us also has grown. I think often we talk about the origins of CDFIs and kind of where the initial capital came from, and I think it usually goes back to nuns, which is part of the case for Inclusiv as well. Of the original impact investors and socially motivated investors, and then I think we've seen that grow to CRA offices and banks, and also private foundations as they've really looked at their own endowments. I think it's continued to grow in the foundation world, but we also have seen, I think even more so in the past couple of years, more corporate investors looking at impact investing. We have started to connect with more kind of corporate treasuries on how can they be thinking intentionally about impact with their cash, and kind of putting it into institutions that are community-based, and providing them with liquidity to lend. So I think the types of investors has been expanding over these past 10 years as these ideas have kind of gotten more popularized. But we've also seen that, again, we hope that it can be an entry and not the end, that impact deposits are kind of one part of that total portfolio activation. And for us, that also means working with investors, to graduate to private debt investment as well, because that is where we see, real need, particularly now, and real impact. We most recently worked with Comcast, for example, through their treasury office. They had begun years ago doing impact deposits with CDFI banks and credit unions, and approached us in 2020 in the kind of COVID crisis to say, hey, we see there's a need here. We see the work that CDFI banks and credit unions are doing. I think that the COVID crisis, and particularly the Paycheck Protection Program, really called more attention to CDFIs than we had ever seen before, when thousands of small businesses, particularly led by women and people of color, that didn't have access to mainstream business credit, tried to access this federal program and were turned away by a lot of large institutions. And they found their way to CDFI credit unions, that did over $2 billion of PPP loans in a very short period of time. And so we've seen that folks like Comcast kind of came to us and said, hey, we see the work that CDFIs are doing. How can we have impact? And at that time, and still today, there's a lot of liquidity in the market. We didn't, there wasn't a lot of demand for deposits for community development credit unions. And so, we were able to work with them to structure $10 million investment into our racial equity investment fund, investing secondary capital into institutions, particularly with a focus on minority-led institutions to support their growth. And so I think for us, that the past 10 years has been, growth in the types of investors that we're working with, and also their engagement. I think for folks that started 10 years ago, just getting into this, they've kind of built familiarity. Investors have grown their sophistication. And so they're willing and able to do kind of more interesting type of investment, and higher impact type of investment that may be more complex, require more engagement, but again, has more impact.
Thanks, Anne. And I'll turn to Nancy now to kind of give us the private equity perspective. As someone who's been an operator of socially responsible companies and now an intermediary helping that kind of company raise mission-aligned capital.
Yeah, I mean, I've definitely found over time, there's a lot more money out there chasing these investments. In the early days, it was really almost impossible to get people to invest into mission-driven companies. But I was just thinking about how, when I was working with Big Path Capital and we did these convenings of impact investors, I would always be getting the question, what really is an impact investment and what is an impact investor? And in the day, I really tried to take a very generous, big tent approach to this, which was, anybody that had the intentionality of both, having an enterprise that would, build, that would be profitable and also do good in the world, will count it, and if an investor had the same mindset, we're investing for returns for our shareholders, but we're also wanting to do good, well, we'll count that too. And so I think, we watched a really big tent, fill up with people. And that was super exciting. But I think that now we're really going more into a time where we have to be a little bit more discerning. So now, and a lot of this trend, by the way, was driven by, consumer driven, like so much else. Like almost every financial institution now feels like they have to have some kind of an impact product. And some of them, they're doing it because they care. And some of them are doing it again in enlightened self-interest because, they're investors, driven in large part by women and millennials, and the shift in where the money is being held now, want to know that they're doing some good with their money. And so if you're managing their money, you better figure out how to meet that demand that they have. But now I think we need to go beyond the kind of that sort of superficial definition. Melissa talked a lot about metrics. I think we have to get a lot more serious about how to make our money smart and to affect the change that we want to affect. And I know this is part of what Croatan is trying to do, is to give us the tools to use our money wisely. But, I think now I think we've got to have some authenticity meters and be able to separate the people who are really making an impact from people who are just talking about making an impact. And I think the people who are really intending to want to do good with their money need to have an evolved roadmap to help them figure out where to place their money to make the biggest impact in the areas that they care about.
Yeah, absolutely. And I'll turn to Josh to talk now just a little bit of real assets, farmland, forest. We've been doing a lot of work actually since the TPA on sustainable food and ag. We've kind of expanded a large part of our work around that space. So,
yeah, I might say a word too about fixed income, particularly in the public markets, because Matt didn't say much about that. Obviously, Trillium is active in that space. And I just mentioned that because fixed income is often an afterthought, and yet we're very actively engaged in a variety of fixed income endeavors. We've done a lot of work in the green bond space related to renewables, clean energy bond finance, green infrastructure, water, and now increasingly, as Christi's alluding to, in the food and ag space around regenerative agriculture and how fixed income could be opportunities here. One reason why this is important is a question of scale. I think one thing that we're extremely sensitive to is scale. People often use the term scale, I think, in completely fallacious ways, by which I mean we should do impact at scale, meaning we should make it big. But big is not always better. We should do impact at scale, which means we should play scale games, to use a term that historians use. I'm a historian by training. That is to say, to be cognizant of the scale at which you're working. The fixed income capital markets on the public side, public debt capital markets, are larger than the public equity markets by a factor of nearly 20%. Globally, it's over $120 trillion space, and yet it's an afterthought. And indeed, the pre-endowment model investing approach to endowments was the 60-40, right? 60 in equities and 40% in fixed income. And yet clearly the capital markets are allocating much more to debt. And so I think you've got to be really attuned to the opportunities there, particularly around bondholder engagement. And one of the interesting evolutions of the framework from the outset, going back to some of Christi's slides, one of the key vectors of impact we now describe as engagement. But actually, when we first put it forward, we had a shareholder bias embedded in the TPA inaugural framework. We actually called that vector active ownership. And we changed that because the nature of intermediation in the capital markets means that you cannot always exercise ownership, but you can certainly exercise voice and control. And so the idea of being a bondholder, I think, is really important. And it gets back to the larger issue. And this gives me the segue back to real assets. This is the problem with modern portfolio theory and a lot of the thinking about risk. Modern portfolio theory is backward looking. And there's an implication that by defining an asset class exclusively based on the risk of price volatility, which you can measure historically, and you can track certain correlations that help you define the intrinsic nature of an asset class, you miss quite literally the forest for the trees. Right now, we are in the largest super bubble that we have probably ever seen in over a century. Everything is correlated. We saw lots of things correlated during the housing crisis, but now we see everything correlated. And so the premises of modern portfolio theory, developed by Nobel Prize winners, that the historical lack of correlation among asset classes collapses today in the 21st century. So what defines an asset class is intrinsic to the language we use in finance, going back to Matt's initial historical point, that goes back ages, that we do bondholder engagement because we're concerned about the ties that connect us to one another. That's what a bond is all about. We invest in equity, whether it's private or public, to answer Anthony's concern, because we are concerned about shared ownership, whether that's in a private S corp or in a publicly traded C corp. Who cares? It is about equity. That's what defines the intrinsic asset class. It is around ownership. And you invest in farmland, not because you want a double-digit annualized return that you think is going to, hedge you from volatility, because it's not right now. You invest in farmland because you want to create food and fiber to feed us and clothe us. You invest in real estate because you want to house us and you want to create the places where we can be entrepreneurial, where we can come together, whether it's in a local grange or it's in a large factory, to make productive use of the powers that we have as human beings. You invest in timber stands for similar reasons, because we want to make paper. We also want to create biodiversity. And if you only make paper and you forget about biodiversity, we're in trouble. So this is what's exciting about the total portfolio activation agenda, is that it's not sort of, as some people say in the impact investing, doing modern portfolio theory with a twist. It's abandoning modern portfolio theory, which is wrong. We need to invest in things that matter. And I think real assets have been a remarkable hedge going back a decade, when those of us who said divest from fossil fuels and invest in a post-carbon economy, we've made lots of money, practically, not just philosophically, to use the terms here. And if you had divested from Exxon and all the drillers and the coal companies in 2012, you'd be in a much better position from a fiduciary perspective today than many others who presumed they were pursuing the strategy that was posed by Dan in the chat that Matt responded to. Let me maximize returns and then I'll have more money to give away. So I think that's the perspective that I bring to bear on this. And repeatedly, these false dichotomies are really challenging. I know I sit on the investment committee of a very small Black-led community development group here in North Carolina, investing its liquid assets in a very conventional bank that seemed mission misaligned. When we actually looked at the returns that you got from cash at local CDFIs, whether it be Black banks or credit unions in our neighborhood, the returns were better, even though you think of CDFIs as concessionary. So in your cash, you get paid more by investing in misaligned institutions. So I'll stop there.
Thanks, Josh. So I'm just going to give one final question, and not everyone has to answer, but just before we wrap up, I know we've had a few questions come in. They've been intertwined a little already in some of the responses. So, you know, I want to hear where you feel the impact investing field needs to go, or where do you want it to go? What's the opportunity? What's next? Looking forward. So I'll turn to Nancy if you would like to start.
Yeah, I mean, there's so much to discuss here. We're just touching the surface. Maybe we'll get to have another conversation. One of the things I was thinking about, sort of back in the day, we thought about concessionary versus non-concessionary, you know, investing, or impact was concessionary. And I was just thinking now, I like to think about, you know, maybe a little bit more about risk rather than concession, because there's an awful lot that we need to do that isn't easy. There's things that haven't been invented yet. There's populations that don't get invested in because we don't have historical track records, or we're not comfortable with it. So, you know, I think there has to be money that people are willing to put at risk to get some ideas off the ground, whether it be, you know, ag tech, or, you know, investing in, you know, funds run by women of color. There's just, you know, those things that are underdeveloped that will move the needle. And then there's got to be another set of money that's really about scaling the great ideas and doing it quickly, because we are on a precipice right now. There really isn't a lot of, we don't have a lot of time to waste. So that's one of my thoughts.
I would just, if I may jump in, I think there's ongoing work required around metrics. I know I probably sound like a broken horse, but every time I teach this course, my students say this is all great until it gets to assessment. And I would say both the more focus and delineation around metrics and being mindful of the diverse asset classes and diverse industries. And I would dare say more transparency, which of course only happens if we're able to create a safe space and really recognize we are all hashtag work in progress, and where are those continued outlets for us to have conversation. I feel like there have become more of them, and there are these mini cottage industries within a cottage industry, and we've somewhat lost some of the meta leadership around where can you have more roundtables. And so this has been great, but to have those honest conversations without penalty and be able to say why it's hard or how expensive it is, and I think collectively decide how do we continue to move forward. I do worry that particularly in the VC space, many folks will tell me behind closed doors, but not share what the challenges are, what the additionality of costs are, what, to Nancy's point, how do I even have these conversations with my LP if I try to adjust the risk aperture upon which I try to diversify top of funnel of my portfolio. So I do think we've got to push more so that we can continue another 10 years of successful growth and progress.
I have to say, I love the drawdown model, though. That's, you know, when you talk about metrics, like I thought that that's a really good model for helping you level the playing field and where you put your money and how to measure it.
I was just going to jump in here, so I don't want to be the last word.
Go ahead. No, go ahead.
And I did want to say it's good to hear you, Josh, riled up. Miss hearing that. And, you know, I think when I agree with kind of increasing metrics and ensuring that as we see additional investment here, that we don't see greenwashing or social washing, but that folks are making investments that are truly led and driven by folks committed to making impact. And I would say that there have been a number of very public, large commitments around investment in sustainability, investment in racial equity, and folks are still figuring out how to meet those commitments. So I think there's a real opportunity right now for those of us that have investment opportunities to be stepping up and try to take advantage of those commitments and translate them into real investment for impact. And I'll also just, I think as our country continues to struggle with racial equity and investment, I think we have been increasing our focus on minority-led institutions that are led by people of color that have been serving these communities for decades, and in some ways are not, I feel like they're not the newest fintech or innovation, in some ways can be less sexy. But we believe that investing in these institutions with deep roots in community do have deep impact. And so I think we need to look at the institutions that have been around for how this next stage, how do we make sure that they're part of the future as well? Thanks.
Thanks, Anne. And recognizing that we're at time, I'm going to say that I'll take up Nancy's suggestion of having another conversation where we could go deeper on this. Really appreciate all of you for joining us. This is probably the largest Croatan conversation we've had in terms of number of speakers. So I really appreciate having each of you here today. And
Christi, we shouldn't wait another 10 years.
Let's not wait another 10 years. We'll get something on the calendar. But thank you so much. If you would, we have another Croatan conversation coming up in a couple months. So keep up on our list and you can connect with us on social media as well. Looking forward to the next conversation. Thank you.
Thanks, everybody.
Bye, everyone.
Yeah.
Thank you.